What they won't tell you about trading, let's get into it. Now, when I interviewed 10 of the world's leading traders for that book published by the Financial Times, Lessons in Trading Strategy from the World's Leading Traders, and you can download a free copy from the links in the bio, it became an international bestseller for the FT and gave me my own TV show on Bloomberg. First of 18 books that I wrote. So let me tell you what some of the world's leading traders in there told me about what retail clients don't know about trading. As you'd expect, otherwise everybody would be rich, retail clients tend to do the exact opposite of what professionals do. So what professionals will do, will start with a small position size and add to winners. Rule number one. Retail clients will go all in and then they'll add to losers. Professionals won't add to losers. In fact, a famous saying from a very famous hedge fund manager is losers add to losers, winners add to winners. So what's that? Rules 2 and 3. But what point will they add to winners? Well, they won't let a winner become a loser, so they'll wait for that winning position to reach a certain degree of profitability. How do they judge that? Well, it's not by the seat of their pants. It's done mathematically. They will, first of all, create what's called a volatility-based stop loss. In other words, they don't want to be stopped out, because remember, they're trading, not investing, so they're not going to hold forever, which is what investors do. They're trading. They need to be in and out. What they will do is they'll look at the volatility of a stock or foreign exchange instrument or a commodity futures security. And they'll look at the volatility and say, well, I don't want to be stopped out by just regular daily market noise. So they'll put the stop loss about 2 times that regular volatility. The flip side of that is when the stock moves up that amount in profit, that's when they can add to the winner. And they don't want the winner to become a loss, so they put the stop loss back at the entry level, if you see what I mean with all of that. In other words, volatility-based stop loss. Now, here's the other thing. Volatility-based position sizing. Again, another thing they don't tell you about trading. In other words, no matter how volatile the market, and more volatile the market, then further away the stop loss because noisier is the movements, i.e. they're more volatile. Further away the stop loss, smaller the position size. So the amount of risk you're taking on a more volatile security is exactly the same in absolute money terms as on a less volatile one. So volatility-based position sizing adds to the risk management and the money management. Risk and money management are all interrelated. There's a few other things they won't actually tell you about trading. Now, just those things alone will get you probably 90% of the way to being a better trader. Now, you might think being a better trader is about inside information, knowing exactly when to buy and when to sell.